In 2022, Ray Dalio's Bulletproof investment strategy lost $70 billion. Not in a crash, not in a single catastrophic trade, but in the slow, grinding collapse of a system that was supposed to be immune to failure. For 25 years, Dalio's all-weather portfolio was the safest bet in investing. It was built to survive a NY economic environment. Inflation, deflation, boom, recession, it didn't matter. The math always worked. By 2021, $160 billion was invested in this strategy. Pension funds responsible for the retirement security of millions of Americans had bet everything on Dalio's promise. Then 2022 happened. The portfolio lost 22%. Investors fled. Pension funds pulled billions. And the man who built the system admitted something that should terrify anyone holding a retirement portfolio right now. The environment changed. But here's the question that matters. How did one of the world's smartest investors, a man who'd spent 40 years studying economic cycles, miss the one change that would destroy his life's work? And more importantly, what mistake did even Ray Dalio make that investors might be making right now in their own portfolios? In the next 16 minutes, we're going to break down exactly what went wrong, why it happened, and what it means if you're in your 50s, 60s, or 70s with limited time to recover from significant losses. Because this isn't just a story about Ray Dalio. It's a story about what happens when you optimize for the past and the future refuses to cooperate. To understand what went wrong, we need to go back to 1996. Ray Dalio had a problem. He'd already built Bridgewater Associates into one of the most successful hedge funds in the world. His pure alpha fund was crushing the market. But Dalio was obsessed with a different question. What if you could build a portfolio that never lost money? Not a portfolio that just beat the market. A portfolio that was genuinely all-weather. Growth or recession, inflation or deflation, didn't matter. It would always make money. The traditional 60-40 portfolio, stocks and bonds, wasn't good enough. Dalio looked at the numbers and realized something most investors missed. A 60-40 portfolio isn't balanced at all. It's 90% exposed to stock market risk because stocks are so much more volatile than bonds. When stocks crash, 60-40 portfolios get crushed. So Dalio designed something radically different. He called it risk parity. Instead of balancing dollars, you balance risk across 4 economic seasons. The allocation looked strange. 30% stocks, 40% long-term bonds, 15% intermediate bonds, 7.5% gold, 7.5% commodities, less than a third in stocks. It seemed crazy to traditional investors. But the math was beautiful. Bonds hedge against stock crashes. Gold and commodities hedge against inflation. Long-term bonds capture deflation scenarios. Every risk was covered. Dalio launched the all-weather fund in 1996, and for the next 25 years it worked exactly as promised. During the dot-com crash of 2000, when the Nasdaq fell 78%, all-weather barely blinked. During the 2008 financial crisis, when the S&P 500 dropped 37% and destroyed retirement accounts across America, all-weather lost just 4%. 4% by 2020, the strategy wasn't just successful. It was legendary. Institutional investors, pension funds managing the retirement savings of teachers, firefighters, police officers, poured billions into risk parity strategies. Bridgewater's all-weather fund alone managed over $100 billion. And then came the ultimate test. March 2020, COVID crashes the market. The S&P 500 falls 30% in 3 weeks. Panic everywhere. All weather? Down 6%. By the summer, it had recovered. Dalio's reputation soared. This was proof. The system worked. Even in a global pandemic, even when the world economy shut down, all weather delivered. Investors doubled down. Billions more flooded in. By 2021, $160 billion was invested in risk parity strategies, with Bridgewater's all-weather as the flagship. But underneath the surface, something was changing. Something Dalio's models, built on 40 years of data, didn't see coming. The warning signs started in early 2021. Inflation began rising for the first time in a decade. 2%, then 3%, then 4%. The Federal Reserve insisted it was transitory, a temporary supply chain disruption from COVID. Nothing to worry about. Bond yields started climbing, and when bond yields rise, bond prices fall. The 40% bond allocation in all weather, the core of the strategy, started bleeding. But Bridgewater held. The model said bonds were still the ultimate hedge against stock crashes. The models were built on 40 years of data showing this exact pattern. When stocks fall, investors flee to the safety of bonds. Bonds go up, stocks go down. Negative correlation. The foundation of the entire all-weather philosophy. By late 2021, inflation hit 6.8%, highest since 1982. The Federal Reserve announced rate hikes were coming in 2022. This was the moment to exit bonds. But doing so would mean abandoning the core premise of all weather. Dalio had spent 25 years telling institutional investors that bonds are the ultimate hedge. You don't market time, you hold through volatility. In client presentations, Bridgewater emphasized long-term discipline. Stay the course. Pension funds managing the retirement security of millions of Americans listened. They held. January 2022, stocks fell 5%, normal volatility, but bonds also fell 3%. This wasn't supposed to happen. The negative correlation between stocks and bonds, the mathematical certainty that all weather was built on, was breaking down. Pension fund managers started asking questions. Delaware pension system, which had invested $180 million in risk parity, began reviewing their position. Bridgewater's response: this is temporary. 40 years of data supports the strategy. Stay disciplined. But what happened next would shock even the most seasoned Wall Street veterans. Then came the second quarter of 2022, the worst quarter for bonds in modern history. Long-term Treasury bonds, the safe haven that always protected investors when stocks crashed, fell 18%. 18%. And stocks? Also down 16%. The all-weather portfolio was getting hit from both sides. The strategy, designed to never lose more than 5 to 7% in a year, was down 15% by June. Pension fund conference calls turned tense. Bridgewater scrambled to explain. This is unprecedented, they said. Our models didn't predict stocks and bonds falling together, but that was the problem. The models couldn't predict it, because the models were built on 1980 to 2020 data. 40 years of declining interest rates. 40 years where bonds and stocks had negative correlation because falling rates boosted bond prices whenever stocks fell. The models had never seen a world where interest rates went up. By the summer of 2022, the narrative started shifting. Financial media began asking, is risk parity dead? But the bleeding continued. Third quarter, stocks down another 5%, bonds down 4%. The all-weather portfolio, the strategy that promised safety in any environment, was having its worst year in history. And then came the final reckoning. December 2022, full-year results released. All-weather lost 22%. 22%. For context, the S&P 500 lost 18% that year. The risky portfolio that Dalio had spent decades warning against actually outperformed the safe, all-weather portfolio. The exodus began immediately. Delaware pension system withdrew $180 million. Then Indiana, New Mexico, Oregon, Ohio, billions gone. By mid-2023, Bridgewater's assets under management had collapsed from $160 billion to $90 billion, $70 billion withdrawn. And then, in November 2024, the final blow. Wealthfront, the robo-advisor that had brought Dalio's all-weather strategy to retail investors, announced they were shutting down their risk parity fund. The reason? After years of operation, the fund had posted a lifetime return of negative 2.2%. Investors had lost money in a strategy designed to always make money. So what happened? How did a man who'd spent his entire career studying economic cycles miss the one cycle that would destroy his life's work? Here's what was really happening. Something so powerful that even 40 years of experience, sophisticated mathematical models, and billions of dollars in resources couldn't protect against it. Ray Dalio fell victim to a cognitive bias so powerful that even the world's most sophisticated investors aren't immune. It's called fighting the last war bias, also known as recency bias. Here's what it means in simple terms. You prepare for the future by optimizing for the past, especially the recent past. Generals fight the last war by using tactics that worked before but don't fit new realities. Investors do the same. They build strategies around market conditions they've experienced, assuming those conditions will continue forever. And that's exactly what happened to all weather. The portfolio was optimized for 1980 to 2020, 40 years of data, thousands of trading days, multiple recessions, crashes, recoveries, but all that data had one thing in common: declining interest rates. In 1980, the 10-year Treasury yield was 15%. By 2020, it was under 1%. For 40 years, interest rates fell. And when rates fall, bond prices rise. That's why bonds and stocks had negative correlation. When stocks crashed, the Federal Reserve cut rates to stimulate the economy. Rates down, bond prices up. Stocks down, bonds up. Perfect hedge. The all-weather model was built on this relationship. 40 years of data screaming, bonds are the safe haven. But in 2021, that 40-year cycle ended. Rates had nowhere to go but up. And when rates rise, bond prices fall. The hedge broke. And here's the psychological trap. When Bridgewater's models started showing warning signs in 2021, when bond yields began climbing, the instinct was to hold. Why? Because for 25 years, every time critics questioned all weather, the next crisis proved them wrong. The 2000 crash, the 2008 financial crisis, the 2020 pandemic. Every single time, holding bonds through volatility paid off. Success breeds conviction, and conviction breeds blindness. Dalio had decades of data supporting the stocks-bonds hedge, but all that data came from one interest rate environment: declining rates. He had lots of data, but not diverse data. And there's another factor. With $160 billion in assets, Bridgewater couldn't just pivot. Pension funds had invested based on specific strategy promises. Changing the strategy would mean admitting the original premise was flawed. Institutional investors don't reward that kind of honesty. They punish it. So Bridgewater held. Even as real-time data in 2021 and early 2022 showed the correlation breaking down, the strategy didn't adapt. Discipline became rigidity, and rigidity became catastrophe. The final numbers: all-weather lost 22% in 2022. Bridgewater's pure alpha fund lost 7.6%. Combined over $70 billion in client assets withdrawn between 2021 and 2023. Dozens of major pension funds reduced or eliminated their positions. The Wealthfront Risk Parity Fund, which had brought Dalio's strategy to everyday investors, shut down after posting negative returns. And what did Dalio say? In a September 2023 presentation to the Indiana pension system, Bridgewater acknowledged all-weather had dipped below expected returns, but defended the approach as still superior over a decade-long horizon. Translation: we were wrong about the short term, but we still believe the model works long term. Here's the irony. Dalio wrote a book called Principles. One of his core principles: pain plus reflection equals progress. The all-weather failure was certainly painful, but the reflection, the willingness to question whether the model itself, not just the timing, needed to change. That didn't happen, and that's the lesson. So what does this mean for investors? Especially for those in their 50s, 60s, or 70s who don't have 25 years to wait for a strategy to work long-term. Here are the patterns to recognize. First, when a strategy has worked for decades, question whether it's working because it's good or because the environment has been favorable. All-weather worked brilliantly from 1996 to 2020. But was it brilliant, or was it optimized for a 40-year period of declining interest rates that happened to coincide with its existence? Second, back-tested performance is only as good as the variety of conditions in that backtest. All-weather was tested across many years, many recessions, many recoveries, but only one interest rate regime. When that regime ended, the strategy failed. Third, complexity doesn't equal safety. All-weather used sophisticated mathematics, risk parity algorithms, decades of data, but it couldn't escape a simple reality. When interest rates rise, bond prices fall. Now, 3 questions for self-reflection. Not advice, just questions to consider. 1. If you're holding a portfolio strategy that was designed in the 1990s or 2000s, does it account for the possibility of sustained higher interest rates? Or is it optimized for the world we're leaving behind? 2. Are you diversified across asset classes, or just diversified within one assumption about how those assets will behave together? All-weather was diversified. Stocks, bonds, gold, commodities. But all the diversification in the world doesn't help if your core assumption about correlation is wrong. 3. If your portfolio lost 22% this year, how many years would you need to recover? And do you have those years? Because here's what matters when you're over 50 and counting the years to retirement. Ray Dalio can afford to lose 22% in 2022 and wait for long-term vindication. Institutional pension funds have infinite time horizons. You don't. If you're 60 and planning to retire at 65, a 22% loss doesn't just set you back 1 year. It might set you back 5 years, or force you to work longer, or reduce your retirement standard of living permanently. The math is different when the clock is running. Remember, this is educational analysis of historical investment outcomes. It's not financial advice, and I'm not recommending for or against any specific investment strategy. Always consult with a qualified financial advisor who understands your specific situation before making investment decisions. But do ask these questions. Is your portfolio built for the world we're entering or the world we're leaving behind? Because Ray Dalio made a bet on the past, continuing into the future. He had 40 years of data supporting that bet, $160 billion backing it, the reputation of being one of the smartest investors alive. And he was still wrong. Now, if you want to see the opposite mistake, the story of an investor who bet entirely on the future while ignoring every lesson from the past, you need to hear about Cathie Wood and the 75% wipeout of the ARK Innovation Fund. That's next.